Kitco Mining's special coverage of Gold Forum Americas is brought to you by Metalla Royalty.
Going for gold in Africa. This is Paul Harris for Kitco Mining at the 2024 Gold Forum Americas in Colorado Springs. Joining me today to discuss this is Peter Marrone, Chairman and Chief Executive Officer of Allied Gold. Peter, welcome back to Kitco.
I'm happy to be back.
Now, Allied Gold is about 12 months old as a public company. How has that first year been for you?
It has been a time of reflection and successes, and hopefully that begins to demonstrate itself in our share price. What does a mining company have to do? We have to make sure that our block models are right, resource estimations are correct, mine plans are done well, right size operations, where there are expansion plans, we can properly fund those expansion plans, and we've done all the technical work for it. I'm happy to say that 1 year in, just a little over a year, we have completed all of that. We're now in progress on that growth that we've talked about.
Many people say timing is everything in investment, and you perhaps couldn't have timed it better to launch a new gold company. The gold price is up to record levels, $2,600 an ounce. It's up $500-600 this year. Going back last year, it's probably up quite a little bit more than that. So timing's very good there.
Well, it's reminiscent of, for those of your viewers, it's reminiscent, and they know my history with Yamana, it's reminiscent of Yamana. We went public in 2003 with a $300 gold price, and gold price went as high as a couple of $1,000s in the tenor of that company. Taking a company from $100 million market capitalization to selling it to close to $6-7 billion is a bit of a feat. I think we can do it again. And this time we're back at it with a good plan, great management, and what I think is a rising gold price. So we've seen gold price in that year go from just about $1,900 per ounce, that's roughly the price of gold when we went public, to $2,600 today. I think there's still more upside, but boy, does that improve the margins with that extra $600.
Okay, but another thing that improves margins is controlling the costs. In the June quarter, you reported an all-in sustaining cost of almost $1,500 per ounce. Can you bring that down?
So it's already down from last year. So we were down roughly $75 to last year, the same time frame to last year. We've publicly guided that we expect to be down about $185 per ounce this year over last year. That's just as a result of initial optimizations. But let's look at what happens next year and the year after that. We expect that cost to be down again next year. One of our mines finishes a stripping program where we get to higher grade gold. The result of that then is we have less cost, more ounces, and that means that we're getting those costs those ounces at a lower cost. The same will be true at our Sadiola mine. I was referring to Bonikro in Côte d'Ivoire. Sadiola will be very similar. But by 2026, so now we're in September, October of this year. So we're now talking about 15 months to maybe at a maximum 18 months, we'll be in production at a mine in Ethiopia that will be producing 290,000 ounces of gold at below $950 all-in sustaining costs. That will very significantly drive down our costs. May I also add that $950 per ounce comes as a result of grade, as a result of tonnage. It comes as a result of power costs as low as they are in that country. We've negotiated a 20-year power purchase agreement, so a full 2 decades, at a fixed price of 4 cents per kilowatt hour. For those who are familiar, that is about 1/4 of the price that one pays in Canada, which is one of the lower places in the world for power.
Okay, now Peter, at a time when many gold companies have posted 50 to 100% gains in their share price year to date, your share price has actually fallen a little bit. Why do you think your stock chart has been going the wrong way, and what can you do to turn that around?
So, good question. I am disappointed. I am a shareholder in this company. I have a large stake in this company. I've bought my shares. I want that share price to go up. I think there are many reasons for it, but we've tackled those reasons. What are the obvious ones? Mali introduced a new mining law last year that creates uncertainty. I'm happy to say that within the course of the last 3 weeks, we were the first company in Mali, now there have been others, that have reported that we've agreed with the state on how we manage ourselves in the country, how we comply with the 2023 mining law and still respect the rights that we previously had, what we're paying on royalties, the settlement of all outstanding disputes, et cetera, et cetera. So that was an uncertainty that was putting a very deep discount on our share price. That is now beginning to filter through in the market. As I shared with you a few moments ago, when we're the first company to report that, we are an exception. Now that there have been other companies to report that, we've become the rule. So with that then, Mali's back to open for business. Paul, there's another one, and that is our project in Ethiopia needs to be financed. We've said that from the beginning of the year, late last year. We now have a financing package. We're just putting that in place. We've already announced the range of terms that we're expecting. It's a competitive process. It is a stream and a gold prepay that will bring in $250 million for the financing of that project. With those two things in place, those have been the two pushbacks that we've been hearing about why the share price obviously should be at higher levels, but why it is not. I'm confident that we've now passed that inflection point and we'll begin to see that share price reflect the true value of the company.
I want to follow up with what's happened in Mali. The situation in Mali doesn't seem to be as bad as people once thought it would be earlier this year. Some of the agreements coming out have been more moderate than people's worst fears. The agreement you have with the government, is that in line with what we've seen with other companies? Is it much of a muchness, or is each mine negotiated on a case-by-case basis?
Well, all of us are under different conventions, different mining laws, the 1991 mining law, the 2012 mining law. The result of all of that is that the path to get to a result has been a different path, but the result is very similar. How we comply with the new law of the land, which is the 2023 mining law that has now been decreed, how we deal with settlement of all outstanding disputes, and how we deal with royalties and other payments that are to be made to the state, the ownership stake of the state versus the ownership interest of the owner. The result of all of that is that's all been resolved. To answer your specific question, from what we can tell in the discussions we've had, there is comparability amongst all of the deals that have been struck. Where there's a payment due to the state, that payment may vary, but it varies depending on the size of company. A larger one is paying a bit more, a smaller one is paying a bit less.
Okay, now you previously talked about the expansion potential of Sadiola. Now that you have the agreement with Mali, what does the future look like there?
Two-phased expansion, we have not wavered on that. We start spending on that first phase now that we have all of this behind us from a regulatory and social and governmental point of view behind us. That first phase takes us into roughly the third quarter next year. Between new oxides that we've discovered, that mine will transition to fresh ore. It's harder rock. So that first phase is to accommodate some of that harder rock through the existing plant. That will take the production from last year's 175,000 ounces to closer to 230,000 ounces. So a spread between 200 and 230 this year, next year, and several years to follow. Its future, however, depends on that second phase. And that second phase is an entirely new plant that is devoted to that very large inventory of ounces that is in fresh ore, roughly 7.4 million ounces. It's a big inventory of ounces. And that new plant will accommodate that fresh ore. It's designed for it. It's a conventional CIL plant versus what we currently have. And the result is that we'll be producing closer to 400,000 ounces per year at all-in sustaining costs below $1,000 per ounce.
Okay. Now, you're talking a lot about expanding your production profile. You've spoken about the cost, how you're bringing costs down. We've also mentioned how the gold price is increasing. So margin expansion, more free cash flow generation. What are your plans for capital allocation going forward?
Starting point is we're allocating capital to that first phased expansion. That's modest, just over $60 million or so. The second part, more significant, is our project in Ethiopia. That's a spend of another $450 million between now and the second quarter of 2026. And we are firmly committed to the development of that project. That will become, at roughly 300,000 ounces per year, below $950 all-in sustaining costs. Pick your gold price. But that's a big margin. Even at $2,000 per ounce, it's certainly a big margin at $2,600 per ounce. And I think gold price is going higher. So the result of all of that is that we'll be generating some very, very significant cash flow. We are committed to building that project. It has impressive optionality. And if we look at it by comparison to some of the market transactions that have occurred, a recent purchase of an asset that is very similar to this asset, $2.5 billion. Our total market capitalization today, Paul, is $650 million. That asset alone will underpin a value that is at least comparable to that recent purchase of $2.5 billion. So we're very confident that we'll be delivering some significant value, and that's why we feel we should be developing that asset and pursuing that growth.
Okay, let's change track a moment, Peter. Throughout your career, you've been involved in a lot of M&A transactions, a lot of transactions to build Yamana, then a couple of transactions to sell Yamana. We've seen a big transaction recently in Africa. Have there been any deals recently where you thought, wow, that was a really smart deal?
Well, I can't say that I know the deals well enough to be able to comment on what was a smart deal or what was not a smart deal. But I'd say that any deal where there's a sufficient enough amount of due diligence that's been done will prove to be a smart deal. Any deal that is purchased for a price where the purchaser then can deliver value from it, you can optimize it, improve costs, deliver more ounces of production, deliver more ounces in inventory that extend mine life, those are good deals. I think that many deals that are done in the marketplace do reflect that. And so I can't point to specifics and say, this is one that I think is a smart deal or a good deal, but I think that many deals that I see in the marketplace, including those that Yamana did, are very smart deals.
Now, your development plate is quite full for the next few years. At what point do you think Allied Gold will start to look to potentially bring in new assets?
Well, we have a challenge. And it's a challenge, interestingly, that I did not have with Yamana, because Yamana started with a portfolio of assets that were of a certain quality. And so it was normal and logical to say, let's see if we can update and upgrade the portfolio. But this company is a mid-sized company, and I can't think of very many mid-sized companies that are underpinned, one in Ethiopia, so one part of the continent, the other in Mali, the other part of the continent, by two world-class assets. World-class asset is anything that has a large production base, let's say 250,000 ounces plus. We have that with Sadiola and Kurmuk in Ethiopia. All in sustaining costs that are low, certainly below the average in the industry. We have that with one at $1,000 and the other at $950, and generational, at least a couple of decades of mine life. So with that, it's very challenging because you should be upgrading a portfolio, but with the underpinning of those assets, it's difficult for me to see what's in the marketplace, what's in the industry that's better than those. Having said that, I am still a firm believer that this industry should consolidate, must consolidate, and the critical mass of quality assets with quality managements is important. And so do I believe that Allied, as we get through this phase of growth, it reflects itself in the share price? Do I believe that Allied should be looking at things that are outside the company to supplement what's inside the company and grow the size and scale of the company? The answer is yes. We cannot look to the future without looking at the past. And in the past, Yamana went from 85,000 ounces to 1 million. Can we take 400,000 ounces, organically going to 800,000 ounces and take that to a higher number? I think we can.
Well, maybe I should spin that question around. As you mentioned, Peter, you've got two very good assets as cornerstone assets. You also mentioned that your market cap is lower than your peer group. So do you feel vulnerable? Do you feel Allied Gold is vulnerable to takeover by somebody else?
Well, 22% of the stock is held by management. So I think that that's a good testament to the fact that we believe in the company, but also an indicator that we will have to come to terms, and you'll have to come to terms with management who are also owners of the company. Where we're trading today, it would not make sense for us to do a deal. But you asked the right question. Would we be open to a sale of the company? The answer is yes, if the price is right. In 2023, Yamana became open to a sale of the company, and we delivered impressive value with that sale. With a 42% premium with the first offer, and then the second offer, another 17% on top of that, I hope I can say that delivered very good value to our shareholders. So we're open to the possibility of a sale, but here's the trade comparison that I would make to our investors. If within a year or 18 months, we can deliver what we currently have in the company, and we can take to our net asset value of about 0.2 times, so that's not 1 time net asset value, it's 1/5 of that, 0.2 times net asset value, and bring it at least to net asset value, which I think we can certainly do. That's 5 times the current share price. That's one trade. The other trade is someone buying the company with a premium today. Which trade do you want to take?
Okay, yes, I agree with you there, but there's also perhaps a third route, and that's a sort of merger of equals. Is that something that you think could be an interesting possibility?
Absolutely. So if it creates critical mass, we're not committed to being in the seat. I certainly am not committed to being in the seat. I'm an investor in this company before I'm an executive of the company. So if it can create that critical mass, if it can create a better company, if we can create synergies, and there are opportunities where that can occur, we still should have a premium for our shareholders, because at the end of the day, our share price is trading at a discount to where it should be trading. I would certainly be very open to that.
Okay, let me put you on the spot, Peter. If you could wave your magic wand and bring two companies or two assets together anywhere in the world, what would they be and why?
I would then be revealing trade secrets. So I think you and the viewer should be aware that we have not sat idle. Even as we've been engaging in all this organic processes to improve the company, we have signed a number of confidentiality agreements so that we can have a look-see on what some of these companies look like, and they can have a look-see on us. We do have a bit of a reputation for being successful at our business combination endeavors. Certainly that's true with Yamana. We will apply those skill sets to do the same thing with Ally, where the opportunity presents itself. But it would be difficult for me to say to you today, this is the one that I think makes a lot of sense. Okay. But nice try for trying though.
Now, where do you want Ally Gold to be in 3 years' time? How do you want it to look?
I certainly want to get to that 800,000 ounces organic. And why that's important is because it's not just a 100% growth in production, it's what it represents to EBITDA, to cash flow, all the bottom line numbers. So if you have a company that has 100% growth in the top line of production, but is, let's use $2,400 gold, not $2,600 gold. At $2,400 gold, the EBITDA and cash flow can quadruple or quintuple. That's an impressive amount of growth. So it's not just the top line growth, it's the financial measures that we focus on. My commitment is to that at this juncture, and to have that reflected in our share price. Only if an opportunity presents itself that can multiply on that, or that can accelerate that, would we take advantage of it.
Okay, well, I look forward to following Ally Gold and as that plan unfolds, and we'll get you back on the show at some point in the future. Peter Marrone, thank you very much for joining us today.
Thank you.
And we have a lot more to come from the 2024 Gold Forum Americas in Colorado Springs. So hit that subscribe button to see all our videos. I am Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of Gold Forum Americas is brought to you by Metalla Royalty.